that'd be great. And then I'll pass some of this stuff around. And I should, if you want, I should brought my selfie stick. I don't want to put it that way. I'll just pass this stuff around.
Yeah, it's just being. I see if people are following though. People are watching this. This is live to the world.
It's live to the world.
Yep. Well, they're gonna hear him, and they can chat.
Hi.
Hello, it's me.
It's 2 pages.
Thank you. That's the last one. Take one. There we go.
Everybody got one? I'm also going to pass around rental worksheets. We'll go through this as well with you guys step by step. So just grab one and pass the rest down. And if you guys like, you can eat while I talk. So feel free to help yourself to some sandwiches. I made them myself.
Yay.
Some are veggie, some are meat. And so feel free to grab that. This is for my allergy girl.
She's in there.
She's in there, so she'll take that. Everyone got one? Yeah. Okay, so guys, welcome to our Condo Rental Investors Seminar today. So today we're going to talk about condo rentals, how banks look at qualifying your clients, the types of clients that are out there, so everybody can understand that everyone fits in a different bracket. And then we can talk about a little bit about commercial renters versus residential if you'd like to. Okay, so if we have time to talk about that, we will do that today. Feel free, it's open forum. If you have any questions, please speak freely, and I'll do my best to make sure you answer all the questions. Okay, so basically, I broke down the rental program into basically 4 different categories. So that way everyone understands that everyone does fit a different category. I've been in this business long enough that I can tell you that they're going to fit in one of these 4 categories, and we can definitely help the client understand their options when they fit in that particular category. Okay, so the first category we talked about is qualified investor. This is the easiest, simplest way person to actually to qualify and finance. So if you want to know the parameters of a qualified investor, it's very simple. Provable income, okay, good net worth, and all the numbers fit inside the lender's guidelines. So GDS, which is their debt servicing ratios, are well in line. These are the easiest guys to qualify. So what we need is simple: an application, job letter, pay stub, notice of assessment, confirmation of the down payment. We'll have to get market rents when we do that, when we order the appraisal. Okay, and we're allowed to use I'm going to say the average because every lender's guidelines are different on this. So you can use anywhere between 50% of the rental income to help them qualify for that purchase. Okay, so 50% rent. So if it's $2,000 a month is going to be the rental income, we can use $1,000 of that to use that into their income to help them qualify for that purchase, and we have to use all of the expense. Okay, so what is the expense? Well, typically speaking, you're going to have 50% of the condo fee, your principal, interest payment, and also you have to use a heat. Now it depends on the condo. Some condos in the condo fee, your heat's already included in that, so we don't have to allocate an expense for that. But if it's not included, then we'll have to allocate $85 for heat. Okay? Worksheet in front of you. So what might happen is this client may have 2 rental properties, maybe looking to buy a 3rd. So what lenders allow us to do is do a rental offset sheet. So it allows us to put down all the expenses, the income, and then you have either a surplus or a deficit at the end of the sheet. So everyone got one of these, right? Now you use this one pager. So over here, you're going to see the value of the property, principal balance, loan to value, gross monthly rent. So if they're getting $2,000 a month, we'll put that in there. You have condo fees that we also enter in there, which we use 50% of the condo fee. They use fire insurance 5%, 5% maintenance, and 5% vacancy rate. So we have to deduct those as expenses in there. Growth monthly expenses, and you have your monthly P&I, your monthly taxes, and at the end here you see rental surplus or shortfall. If there's a surplus, we will add that into their income and not worry about adding P&I and all that other kind of stuff in there. It's already going to be based on this sheet. And if there's a deficit, we actually take it away from their income. So that way, the numbers work either way. If they own two, they may lose money on one, make money on the other, and that'll be a wash. Okay? So that's one thing you have to understand. So we can either use this rental offset, or we can actually use 50%, depending on who the lender is and who we're dealing with. Okay? Now, one thing also you got to understand is very important. Every lender has a different guideline. So, CMHC or the general guidelines, you have to put 20% down on the purchase price. But some lenders still see that as a high ratio risk and will charge you a CMHC premium on 20% down. Okay? Not all lenders do it, but some will. Or they may charge you a rate premium on the rental. So the best rate right now is say $269. They may charge you $299 on the rental.
Like which lenders? We're talking about major banks?
Some major banks do, some major banks don't. Scotiabank does, TD does, I don't know Royal Bank does, or CIBC. Every deal is different and it really depends on the client and how badly they want them over there. Okay? And a lot of the lender's guidelines is simply you cannot have more than 4 properties, including your owner occupied. After that, you become more of a commercial lender, and they change that altogether. A lot of banks just won't touch them. Some of them will. There's, I think TD has, I think they changed their guideline too, right? They changed their guideline. National Bank, you have them 16 doors. CIBC also changed their guideline now, it's 6. So every lender is kind of different. So when your client comes in, we'll assess their situation and let them know where they would actually fit in for that rental program. Okay? Any questions? I see everyone writing down. I like this. That's clear as mud, right? Okay, perfect. Your next one is your unqualified investor. This seems to be the norm out there. Unqualified investor, typically self-employed, right? Real estate agents, commission salespeople, where you know what, they make great money, but unfortunately due to the situation they're in, there is no longer a stated income rental program for non-qualified. Okay, so it doesn't really matter how much money you have down. Most banks do not accept it because the numbers have to work. The thing they look at is you cannot be solely dependent on the rental income to make your payments. And the reason why they don't want that is, I'll give you a good example. If I have my own personal house and I have a rental that's sitting vacant, which payment am I going to make first?
Yeah, you get all of them.
Right? So they don't want you to be solely dependent on the rental income. So that's why they want to see the fact that you do qualify with 50% of the rental and not 100% of the rental. Okay? So where do these people fit? Well, typically speaking, you have to deal with an equity lender, which are places like Home Trust, Equitable Trust, Optimal Mortgage, B2B. So it doesn't mean they can't buy an investment property. They just have to be prepared to the fact they have to pay more to buy that investment property. The rates can range between $3.99 and $4.99.
From $269.
That's correct. So the choice is either you buy it, pay more, or you don't buy it at all. Now everyone says that, right? So let's look at it this way. If I took the same deal 8 years ago, you'd be paying $7.99, and a good 5-year fixed rate was $3.99 or $4.99. So you have to realize it's all relative on that part. Banks are having to pay more interest. Yes, the cost will be more, but they have to decide what's more important to them. Paying the $4.99 or $4.25 or whatever it is, or buying that property. Or not buying the property. Okay? So, now with condos, Unfortunately, at an equity lender, typically they will not allow you to put only 20% down.
I'm sorry, is this for self-employed, you said?
Self-employed or even equity lender in general, if you're buying a condo as an investment property, they like to see a minimum of 25% down. Some will want 35% down. So these are things that we will prepare your client when we sit down with them and find out where they fit. So if they're unqualified, self-employed, then chances are that, like I said, they're going to have to pay more, but they also have to realize that there's a reason why they would want to do that. Okay? Any questions on the unqualified?
Unqualified is me, so there's no question to make myself happy.
Well, even for now, for commission salespeople, and I don't want to get off topic here, even for now, just straight commission salespeople like real estate agents, we can only use what you claim on your line 150.
Yeah.
So even if, for example, your gross commissions are $150 or $100,000, and on your notice assessment only shows 50, we have to use that number to qualify.
Makes sense.
So I'm sorry about that, but I don't make up the rules. If I had it my way, I use your gross, but unfortunately I have to use your net. Also for self-employed, just simple, we can state their income. It is a lot simpler to get done. It just costs a little bit more.
What if you have savings, I mean?
Net worth doesn't matter anymore. I have a lot of clients of mine are self-employed. They show like $50,000 in notice of assessment, and at the end of the day here, they have $500,000 in bank. Typically, it doesn't matter. It's just the way OSFI and the B21 rules and all these new rules, they just don't allow it. It has to be a reasonable income for what you do, number one. And just because it's stated income, you can't do it. Okay? So that's something you have to understand. Any questions about that? Okay, good. This is our favorite. Next one, foreigner, non-resident investors. Okay? We try to keep this really, really simple for you. And again, investors non-resident investors, standard right now is basically 35% down. Okay? We have to be able to confirm their income from whatever country they're from. Okay, the problem you run into a lot of stuff is businessmen from certain parts of the world make it very difficult for us to qualify that income-wise. And also you have to understand that there's some sanctioned countries we cannot do mortgages for. Okay? I'll give you some of them. West Africa. Iran.
Yeah.
Iraq. Afghanistan. What else is there? Cuba.
But our money is building this country.
Yeah, so if there's a sanction against the country from the US or Canada, we cannot finance those people at 35% down. Certain lending institutions have a little bit less, a smaller list of sanctioned countries, Scotiabank for example, but their guideline is if you're a foreign investor, non-resident investor, it's 50% down. Okay? But there's a small catch to that. You have to use it as a secondary home, either for family, students, whoever. Cannot be a rental.
I'm sorry, what was that?
The Scotiabank, 50% down, but it cannot be a rental.
Oh, it has to be a primary.
It has to be a secondary residence. After closing, sorry Scotiabank, but if you decide that 6 months later you want to rent it out, they really can't stop you from doing that. But your intention should be for a secondary home. Okay, in that part. Foreign students, so a lot of people come from China, Iran, all of South America, wherever. And what ends up happening is when they come here, they have their family here that they want to buy a rental unit or a unit for their family to live in because their kids want to go to school. In that case there, the parents have to sign. It can't be straight out, I'm a student, here's 35% down, no questions asked. It doesn't work that way. Okay? So it basically just works the fact that the parents have to sign, they have to co-sign for the family, they guarantee the loan. They can't put the student on title if they like, but that's something they have to do. Okay? And the parents have to fully qualify for that income-wise. Now, we're not gonna ask for a bazillion things on that. It's just simply employment letter, pay stub, or a tax return. Not every country has a tax return. They'll have to have confirmation of the money's in their bank account. At home, we have to see the wire transfer to the Canadian bank account. The money's gotta be here at least, depending on the lender, between 15 and 30 days in a Canadian bank account. Okay? So you have to prepare your clients to make sure that if they are gonna buy a property here, the money should be brought over as soon as possible. Yes, that's another thing. You have to be here to sign.
Oh, the power of attorney.
No power of attorney, nothing like that. So we kind of figure a way around it, okay?
Number company.
No number company, no wing wangs, nothing like that. So the only way you can really get around this is the client say it's gonna be here for 2 weeks, buys a place in week 1, we get him the approval. Okay, he signs all the documents, we get all the documents that we need, send it back to the lender, have the lender instruct the lawyer. As soon as the instructions are sent to the lawyer can sit down with the client, go over the documents, sign everything with them, and then they're free to go.
As soon as they do the purchase.
As soon as they go back to the lawyer, sign all the legal documents for the bank. Okay? So, because that's basically what you wait for. That's what most lawyers wait for, right? So if he's buying a place, say on today, and he's closing the end of June, okay? But he's only going to plan on being here for 2 weeks. So it's better to extend his stay for a couple of days, get the approval, get him to sign all the documents, complete the file, and have the lending institution instruct the lawyer early, so the person can sign. As soon as it's instructed, they can sign all the mortgage documents, and then he's free to leave. And then we just wait for closing. Okay? So that's basically, any questions about foreign investors? I'm good at this.
Well, what about like foreign investors, like that might be buying resale, but new construction, is there?
Here's my problem with new construction.
Yeah.
So let's say today they have a program that allows your client to buy. But this building ain't closed in 2020. Okay? 2 things can happen. 1, banks change, well, interest rates are one thing. 1, the banks change their guidelines completely. Say, you know what, we're not doing, and it's happened. We're not doing this at 20% or 25. Maybe at a time he wants to put 35% down, and then 5 years from now they say, well, you got to put 60% down. So that's something that may happen. So that's a problem. Okay?
That's a risk.
That's a risk that they have to take, number 1. Number 2, you're right, interest rates. So they may qualify today, but if rates go to 7%, that deal may not make sense. And number 3, real estate market can collapse. I'm not saying it's going to, but what happens if all of a sudden crap hits the fan and real estate prices start to decline? Then what ends up happening is he bought it for $400,000, and by the time he closes, the bank says, well, you know what, it's only worth $265 because we take the lesser of the purchase price or the appraisal. So that's another thing that that might happen, but we can't obviously predict what's going to happen with that. But those are risks that are part of it. So newer construction is very difficult because you may be pre-approved today even by a TD or Royal Bank or Scotiabank, and that pre-approval is good for 3 years. But if it takes 5 years to close, that pre-approval isn't worth anything, right? So these are things that we can't control, unfortunately.
Are you saying that the party is over for some countries? Some investors, basically?
No, not necessarily. I mean, like if you want to look at Iran in particular, some sanctions have been
Not that I
lifted.
deal with them, but then.
Some sanctions have been lifted.
Yeah.
And what I want you to understand is the fact that if they come here as a permanent resident,
Yeah.
right, then that changes a little bit. So I'm not saying the party's over. I'm just saying the guy's just a pure investor, and he wants to come here and he has trouble because of the sanctions. Huh?
For capital.
Yeah, we won't talk about that. I would say 2 things. If that doesn't work out, 2 things you have to look at is either private money, so we get a private investor to lend them the money at a higher interest rate is one way to do it, or he's got to pay cash. And according to most Iranians, they have it, they just don't want to use it. Right? So that's another thing. I mean, they're free to pay cash. That's not too much of an issue. And another thing I want you to understand is, as soon as you're here as a foreign investor and you're with a banking institution, you're life partners. You cannot decide one day I want to refinance or go somewhere. It's very difficult. You may be able to do a straight switch with some lenders, but because they've been approved there, and now if they're a sanctioned country, something changes, they may be stuck there for life, until life of the mortgage. So I need to pay it off or sell it. So that's basically their only outside.
And do, after the, like a mortgage term, so after 5 years, like let's say the sanction is removed and it comes back in the 4th year, and then after your 5 years, you need to
So let's say, for example, you get approved.
renew your mortgage.
Yeah, so
How would that work?
You'll have to just renew with the same lending institution.
With the same then?
The
But
same
they would do it.
As long as he makes his payments, chances are they will do it. Because they don't really look at requalifying you at maturity. They just make sure you made all your payments. Now, if he's a delinquent on every payment, they might say, hey, listen, we're not renewing.
Subject to.
Yeah, subject to the fact that he makes all his payments, and chances are they will renew them. Because now banks put that clause in there. Before, years ago, as soon as you were with a mortgage company, they basically had to renew you. They don't have to do that anymore. They have a note there that says, we may choose not to renew you at maturity.
Yeah, the sanctions really relate to the money coming in for the down payment, right? So the countries that are sanctioned, the banks have to abide by the anti-money laundering laws, which
Anti-Terrorism Act.
Anti-Terrorism Act, that all got enacted basically after 2001, right? So that's really it. So you're right, on maturity, they don't really care too much.
No.
So.
And I had a client, actually one of my agents had a client at Bank of Montreal, money came in from Jordan, and they put a hold on it. And she's like, I don't understand why. And I said, well, the reason why they put a hold on it is they're not sure where the source of money's coming from. So they got to do a bit of their investigation at the end of the day. But these things that can happen, so these are things that people have to be prepared for. It doesn't happen very often, but it can happen.
Can we talk about line of equity?
Line of credit?
Yeah.
Yeah, it's very easy, no.
For instead of mortgage, what I'm saying.
For rentals, again, when investors come in, it's very difficult to get lines of credit. Most banks don't want to actually put a line of credit on a rental.
Yeah.
They kiboshed that program probably about 2 years ago.
Yeah.
So unless you've had it for a very long time, the chance of you getting a line of credit is going to be very, very slim. I've yet to have one get approved.
But for your primary residence?
Primary residence is not a problem. So, for example, your client wants to buy an investment property, so he decides, listen, we're going to put a line of credit on my house in order to put a down payment on it, because that becomes tax deductible, rather than using after-tax dollars like cash. You can do that. Okay, so that way you get the full write-off on it. Okay, but to put one on actual rental property is very difficult.
Can you transfer it to another? If you sold the property, can you transfer it to another property?
Yes, your mortgage is portable.
That's not the mortgage though.
Oh, the line of credit?
Yeah.
No. Lines of credit are non-transferable. You can't port them, so you have to basically pay it off and try to reapply for a new one. Okay, because it's based on the equity of the house. So if you bought, say your house was worth $700,000 and you bought one for $500,000, now the collateral charges got to change. Okay, so that's why it's non-transferable, because the properties are totally different, the security is different, so they have to discharge it and re-register it. All right. Any questions for investors?
Yeah, I have some questions.
Okay, go ahead, ask.
Yeah, for like because I'm from China,
Yeah.
I may have some Chinese clients, but for their they only can transfer 50,000 per year from Chinese banks to here. So
Okay.
in my some clients maybe will have this question: how can they put like 50% down payment here?
That's a great question. I have to say that some of my Chinese clients, or most of my Chinese clients, wire money on a regular basis in the hundreds of thousands of dollars to their kids who are going to school here. So I'm not sure when that guidelines change. I'll have to look that up for you. But is the Chinese government change that rule?
No, they just put like 50,000 per year.
Right.
Per person. Maybe they.
Since when is that rule?
I'm not so sure.
So like
a few years ago.
Okay, so per person, you mean like, for example, if Ryan and I are partners,
Yeah.
right? And he can transfer 50, I can transfer 50, so I can bring 100 here? Or is it based on how many, if I have 5 children here, can I each send them $50,000 per year?
No, per person to transfer the money. So.
Okay. I don't know how they get around it. I'm not sure if there's like I'm not quite sure. I can't answer that question, but I'll see if I can find that information for you.
Thank you.
Okay.
I will also ask around.
Yeah.
Maybe they can ask some relatives to have. I'm not so sure.
Yeah, I'm sure it's like grandma, grandpa, mom, dad, and then you have $200,000 here, right?
Yeah, I have a kid who his son graduated university, smart kid, Chinese kid, and his dad wired him $450,000 to buy a car for his graduation present. Bought him a Rolls Royce. Anyway, and then the dad said, to him, listen, why don't you buy a house? Find a house here. And he's like, okay, Dad. So the house he liked was $4 million, and his dad sent him $4 million. So I'm not quite sure how that works.
From other sources.
It must be from other sources.
Maybe from the parents' company.
Don't know how it
But
works.
it's not like personal banking.
Okay, and I have another client that her husband lives in Hong Kong. She lives here, and he sends her about
Hong Kong is
$100,000.
fine.
It's Hong Kong, so it's actually
Hong Kong is
in
fine.
China. Okay.
Yes.
All right. So I'll find that out for you on that portion. Okay. Any more questions about foreign investors? Okay. Awesome. Last one we're going to talk about are professional landlords. So what is a professional landlord? It's somebody who has a business simply buying rental properties. They probably own 4 or more properties. Okay. They get most of their income off of property. They may have a job that they work at on a regular basis, makes an income, but majority of their income that coming through the tax return is going to be from rentals. So they may own 4 plexes, 5 plexes, 10 or 12 condo units, and they're all rentals. That's your professional landlord. Now, typically speaking, there's only a handful of lenders that actually deal with these people. National Bank's one of them. CIBC is another one, for sure, those two. And you know, you can deal with the home trust and equitable trusts and trust companies as well. But basically people or the banks themselves look at that as more of a business than they do looking at it as mortgages. So they're going to look at you a little bit differently, okay? And some bank institutions are just getting out of the game altogether. So typically speaking, that's when the rental rate worksheet comes in handy. So we'll put down basically all their properties they do own and come up with a number so we understand what the debt servicing ratio on that is. And basically what debt servicing has to be is for every $1 of expense, I have to collect about $1.15 in income. Okay? So if it's $1,000 a month, that's my expense, I have to collect at least $1,150 in income to make that deal actually work. Okay? So again, I've dealt with lots of clients that have, you know, if somebody wants to buy, for example, 22-unit apartment building. Now the beauty of this is it's based on the merit of the property to carry itself. Okay? It's not based on my personal income if I'm buying that. So if I'm buying a 22-unit apartment building, they're going to look at vacancy rate, management, upkeep, the gross rentals, and how much money you have left over after every month after all your expenses. And that's the number they're basically going to use, which is what we all know better as a cap rate. Okay? The only small problem you have here in Toronto, property prices are very high and cap rates are very low. So what ends up happening here is they might be able to buy a building for $1.2 million or $1.3 million, but when we do the numbers, the value of the building may only be $800,000. So the lender's going to say, hey, listen, you know what? We're going to give you 75% of the $800,000 rather than of the purchase price. Okay. A lot of these buildings, most lending institutions want to get them CMHC insured, and the rate savings, if you can get CMHC insured, are huge. So if you get a commercial mortgage, it might cost you, say, $375 for a 5-year fixed rate on the commercial side. And if you get CMHC insured right now, I think the rate's like 2.1 for a 5-year fixed rate. Okay, but they do have to pay CMHC insurance premium, and CMHC will set what the value is through the numbers and the cap rate. So even if you buy $1.2 million, CMHC might say, hey, listen, it's only worth $800,000, but they're willing to give you 85% loan to value on the $800,000. And like I said, the interest savings, you pay back your CMHC premium in 2 years. And as soon as CMHC insured, it will always be CMHC insured. So you're always going to get the best possible rate. And that's basically about it. Any questions about professional landlords? No?
Minimum down payments?
15% of the value set by CMHC. Yeah.
Would they actually do it at 15?
Well, the thing is, like I said, the building might be worth, buy it for $1.2 million, it might be worth only $800,000 in CMHC's eyes. So they'll give you 85% of the $800,000. So what I want you to know, of all the deals ever done like that, not one's ever come in at value,
So you
purchase price value.
need a lot of cash.
So more like 25%.
It's close to 30. It's close to 30%. Okay. Now, if you guys want to talk about commercial rentals, I don't know if you guys run into this every once in a while. A person wants to buy a place on Dufferin Street or Dundas with a storefront apartment. Sorry?
Mixed use.
Mixed use. It's considered commercial. Doesn't matter how much commercial. It could be. They used to have a little guideline. They say if it's less than 25% commercial, we can use it as residential. Even if it's zoned commercial and it's a house and someone lives there as a house, it's commercial. It becomes very difficult to change that. So standard on those mixed uses is probably 25% down. Okay, and it's small commercial, so typically the rates are going to be higher. They probably start around $499. Okay, because of the commercial use in it, and there's a handful of lenders that will do it, and most of them are going to be either credit unions or trust companies that will look at doing that. Duca, Home Trust, Equitable Trust, BDB. Well, BDB doesn't do that. And no, Hawthorne doesn't do that, so that's basically the lenders that are going to do it. Okay? And again, it's strictly on the income of the building when it comes to the commercial stuff as well. Okay? All right, just a couple of notes. Please note that if the client is putting 20% down, which is a threshold, minimum down payment, they can be subject to CMHC high ratio premium, and they may be subject to a prey premium on that.
That's a general comment, right?
That's general comment.
25%.
25%. Most lenders will forgive the CMHC premium and the rate premium, so I'm just going to let you know that. Okay. Yeah, non-qualified investors may be subject to higher down payment and higher rates, so that's another thing you guys have to realize. It's great that people want to invest in the real estate market. I think it's a great investment, not just short-term but long-term. And you know, it's always good to have bricks and mortar because you can always visit it, you can always go touch it, right? You can always kick it, and you know the fact that no one can steal it, right? And if it burns down, that's why we have insurance. So it's a very safe and great investment for just about everybody that can do it. So I highly recommend that on that portion. And if you have any clients, any questions about how to qualify for the rental, please have them set an appointment with myself, Farah, Mike, anybody, and we'll sit down with them and make sure they understand which category they fit in and what it's going to cost them to get in, and that way they know for sure where they fit. Okay? Guys, thanks for coming. I really appreciate it. Please help yourself to some sandwiches. And then I got you your allergy-free salad.